Hello, 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 everyone. Mike Arnold here, co-founder, Pat Trading Partners, along with Bob Iacchino, who I'll bring on in a minute. Real quick, I have a hard stop today in about 30 minutes, so it will be a little shorter session. Then I will be back, hopefully right on time for the stock session. Tomorrow, let's just get through some of the stuff. Just remember, 7:30 Central Time retail sales. So don't ignore that. And then the big thing tomorrow is the FOMC and really the press conference because it's pretty much baked in. It's a quarter point. Uh, you can see green across the board except for some oil, which, hit all our targets on that pullback. We're back into that pullback zone. So I am watching for a better bottoming pattern. We can take a look at that too, especially some of this we'll look at in the next segment, so it'll be more market overview part 2 and stocks. All right, so with that, let me just say, anybody new here, please do consider subscribing, ringing that bell, and hitting that like button. Longer term viewers definitely like the video, especially since Bob's on it, and leave a comment. Let me disappear small Mike, disappearing small Mike, bringing on Bob Iacchino. Oh, wait, we don't want. Oh, there we go. There we go in the corner. In the corner. You can't put baby in the corner.
You almost need like cue cards as to which one you're supposed to click.
What was that?
You almost need like cue cards as to which one you're supposed to click.
I know. Well, I'm getting old now. Not as old as you, but I'm getting old.
Yeah, you're younger than me.
Yeah, I know. That's scary. Hey, Tesla Force. Hey, Dan Jet. Hey, Options 22. He says hi to you too. There we go. Nobody who tunes into this stream regularly should have been surprised. I said I was watching for one of those massive rallies at sometime in the first 3 days of this week. And here's your massive rally. Also a very aggressive buy signal. Looks like it may trigger today, depending on where the futures close in a bit. Hey, Sterling. So we should not have been surprised by the crude sell-off. We had that one nailed with that double pattern. We shouldn't be surprised with this rip your face off rally, especially with watching the live stream this morning. And with the pullback gold silver, we had that with our head and shoulder patterns. Wow, we're just knocking it out of the park. That means everything's going to go haywire. Since I just said that. So let me just do a quick overview. Then you sent me a bunch of stuff, Bob. We'll jump into that.
Yeah, just two things.
S&P up at this point. The futures are still going, of course. Just over 2%. Nasdaq up 3%. Dow up 1.75%. Russell lagging a bit at 1.4%. Crude down a big 8%. Gold off 2.2%. Silver off only 0.91%. Silver holding up better. If you didn't see, the U.S. Mint has a silver shortage. So that's where we sit. First off, what did you think of the today's rallies?
Well, I think it made sense given that some of the economic data that we got, along with the issues in China, kind of gave people the idea that longer term, the Fed was going to be kind of let off the hook. We had PPI come in a little bit lower than expected, 0.8 versus 0.9. It's still, by the way, at historical highs. Core PPI year over year, 8.4 was expected at 8.7, but it only came down from 8.5, but still headline 10%, 10%, 10%, actual forecast and revised to 10%. Still at historic highs, but gave people a little bit of a take a breath moment in terms of inflation drivers. Secondly, we had crude oil falling, which is another inflation driver. So crude oil is now fallen 4 of the last 5 sessions, over 26%. I'm sorry. Is that right? It might be more than that. I'll tell you really quick because I have it right over here. Template 2, I think it was. No, that's gold. Actually, I can look at gold and tell you, yeah, over 26% from the highs. Crude oil has fallen. So it's fallen 4 days, where 3 of those days have been over 5%. And one of those days was over 12%. So that's an inflation driver as well. gives the Fed a little bit of a breather, gives people a little bit of a breather in terms of what's going on in markets. And then last but not least, China is stimulating, but China has locked down a city of 17.5 million people. Chinese stocks on the Hong Kong exchange, the Hang Seng Index, had their worst day since 19, let's call it worst day in 20 years. Okay. And also the Hang Seng fell 14% Monday, 6% last night. All of that giving the idea that even though China is stimulating, you could see a slowdown in China in terms of their demand for commodities. So all of that giving the inflation picture a breather. None of this seemed to be geopolitical to me. I want to throw in really quick with the crude oil. I'm not a foreign policy expert, but Russia got written guarantees from the US, according to Bloomberg, that they would be able to do their nuclear deals with Iran. You know, Russia is negotiating the new nuclear deal with Iran, which would bring Iranian oil back into market. So if you're wondering if it's chicken or egg in terms of crude oil in part is falling because the Iranian talks are back on because the West trusts Russia to negotiate that. And they were given written guarantees that they'd be able to do their nuclear sales to Iran in order to restart the talks that would get Iranian crude back on the market. It's just kind of bizarre overall. So I think today's rally, given all of that, it made sense. I still don't believe that it's necessarily a snapback rally that's going to cause us to permanently come out of bear market territory, but I could be wrong about that.
Yeah, so let's see who else is here. Hold on, we gotta get to some of the people. Hello, Sashi. Bob, your original oil target was 95 to 100. Now that we've come full circle, what's your near term and longer term price target?
Well, I don't have a buy signal in it. So I don't really have one. This is one of those situations where in our old trader outlook service, I would put crude oil at reassessing. Okay. Right now, if the 50 holds, like you see on the chart there, and we start to move up and we get back above the rotation zone and it starts to angle up and widen out again, I would look for a pullback to buy. But other than that, I'm in a reassessing camp on crude oil. That's a great chart right there, the weekly. As you've probably heard Mike say a million times, I need to see that hold, not just us to get there. I don't catch falling knives, neither does Mike. I'd rather miss the very bottom and see it hold and move back up and catch that hot air balloon as it's going up rather than jump in it as it's going down and hurry up and pull the fire and try and get it to go back up. You
Yeah,
know,
the only thing I had, which is probably going to turn into a triple, was this little 1 hour. It was on the 15-minute 1 hour little double that came up to the rotation zone and rotating back down. So that's the thing. It's still not off the table yet, but that's the only thing I was watching. But that's a very short-term bounce pattern. I need something longer term, especially since we could still easily pull back into this would be the 50 to 62 and a half, and everybody knows on this channel how much I watch that 62 and a half bottom of the weekly rotation zone, just back into the channel that's this just popped out, and we talk about this many times: vertical up, vertical down, because these moves a lot of times aren't sustainable. They're event driven, and they can keep going for in one direction longer than you think, but they can also reverse a little more than you think too. So, I mean, the whole oil situation. I mean, we're almost back to where it was right before the Ukraine situation, but before that, it was already headed up longer term. Uh, let's see. So yeah, you're reassessing. I don't have any longer term or even even a 4 hour buy signal yet. Let's see. We have Wavy here. Hello, back to buying in full force. That was it. Sterling sold his last CVX put options today for 308% profit on a trailing stop. Thanks for teaching us how to trade, Mike. Should I send you my address for the check?
yeah, I appreciate you. I appreciate you guys recognizing when we call something and it's right. I didn't trade it, but
Are we done selling? Well, again, I was watching this for the short term bounce. I think the short term bounce has a little more legs, but this is where our we haven't hit a key level yet. But this is where I like to trail, because if it does roll over hard, again, anything can happen. And given this back and forth and volatility is still high, you could see and we are still in negative gamma mode, you could see another down push should something bad happen. So this,
Mhm.
but the only way I could do that is trail a stop at this point until we get up to some key levels. We're not at key levels where I look to unwind this short bounce pattern yet. Rich is here. Biden is under sanctions now. We will not be able to buy Lada card nor have holidays in Siberia. Yeah. All right.
That's really good.
Rich wins the comments. Wins the comment of the live stream.
That's really good.
Market is pricing in 0.5% now, as per Bloomberg.
I mean,
So
somebody asked me for a comment, a writer for, I think, Coinbase. I don't remember who she writes for. And I said, I'm still in the camp of 3 rate hikes, but that's only because I'm not willing to forecast the rate hikes past the next 3 meetings. So, in other words, I'm not willing to be incorrect. I could still be incorrect, but it's just silly because, like you hear, I was laughing the other day because I was driving to the gym and I was listening to Bloomberg radio, and they were saying Goldman Sachs has now dropped their S&P target to 4,400 for the end of the year. They had previously dropped it from, no, I'm sorry, it's 4,500. They had previously dropped it from 4,900 to 4,700. Now they dropped it to 4,500. So you mean as it drops, they just cut it 200 round points and they just move on.
and
It's
didn't
like
I
a
say when
silly
we talked?
thing.
We talked about the drop to 4,700. Rich, I think you put that in here, and we talked about that the other day. And I'm like, next time they drop it, there's going to be 4,500 because they dropped 51, 49, 47, 40, and now I guess they dropped again. Uh, let's
Hey, if you don't mind, Mike, that's a good segue to what I sent you, and then I can get off and let you finish and have your hard stop. Can you throw up the image first?
the image first.
It was the second thing I sent you.
I got it. I am prepared.
All right. So this is from Ryan Dietrich on Twitter. He's a chief market strategist, senior vice president for LPL Financial. And just to give him full credit, his handle on Twitter is at Ryan Dietrich, which is Detrick. He's a very good follow, keeping in mind that he's a financial planner. He's an RIA, right? A registered investment advisor. And he's always looking for these, in the last 10 cycles we did this, or in the last 4 times CPI was here, stocks did this. And I love reading his stuff because he puts out a lot of interesting stuff like that. But this one interested me in terms of doing a little bit more work on it. So stocks tend to do just fine during periods of Fed hiking. Now, the reason I pointed this one out is because I thought it was way too simplistic, because rate hikes are for different reasons since World War II, under different Fed chiefs with different economic scenarios. So all Ryan was trying to do was to tell his investment advisor clients and their clients, don't worry about the Fed rate hikes because stocks can go up, and they mostly do during Fed rate hike cycles, right? And he's not wrong. And he's also not being shady at all. I don't mean to imply that, okay? So he's got percentage return during the cycle and annualized return during the cycle, and most of them are positive, right? Now it's very not misleading, but like the first rate hike took place over like, what is that? 6 years, 7 years, from 1946 to 1953. There's another one that was 3 years long, from 77 to 80. Anyway, you can go to the spreadsheet, Mike, because I basically took all this and put it in a spreadsheet. Okay. All right. So the stuff in yellow is basically what you just saw in the image.
I'm
Okay.
going to expand it for people.
Yeah. I'll go specifically to the stuff on the right. If you just keep those orange and pink columns that are in the yellow on display, Mike, you can expand it past that and just keep the stuff during the right. These are all the things that were in that image. And again, if you want to see that image, just go to his Twitter. Here's the returns during, and then the annualized returns, right? Returns during the rate hike cycles. So in only 3 of these periods were equities negative during the cycle, and did they have negative annualized returns? And those are in orange. And then I highlighted the other one in that sort of pinkish color because it was 0.1 versus 0.1. So yeah, they weren't negative, but they didn't really go up either. And if you go all the way to the right here, I have the starting CPI of the cycle, the ending CPI, and the CPI 6 months later, right? The only time that stocks were negative was when the endings in green there is when the CPI was higher. In light blue is when the CPI was lower. Okay, ending the cycle and 6 months after the rate hike cycle. So most of the time, right, it ends up a little bit higher. Only in those light blue areas does the CPI actually go lower during the cycle and 6 months after the cycle. In the green, it's all higher than the previous sell. All right. So if you go across from the orange cycles, you'll see that in the two where it's massively negative, the negative 11 and the negative, I think that's an 8.7 there, you'll notice that NGDP was blue or lower, but inflation was still higher. Okay. In the other one, the other time that happened is when the annualized returns and the return during the cycle were only at 0.1. Now, I know this is really confusing, right? But all this basically means is if CPI continues to go higher during this rate hike cycle and GDP goes lower, that's stagflation and stocks don't do well. That's what all of this work means. And that's what I think is happening. Okay. I think growth is headed lower, and I think CPI is headed still higher, even though the Fed's going to tighten rates, because a lot of what's driving CPI is not under the Fed's control. Now, that one in the point, 0.01, where it's actually like 1980, go to that last thing on the left bottom, Mike. All right, so that's the 1980 period, and stocks didn't go lower. But look what happened in 81 and 82. Okay, all the way to May of 82. That month is by numbers. So 1 is January, 2 is February. And if you look at the year following that rate hike cycle, you basically had an average return of down 0.58%. And you look at all those years that were, all those months rather, that were negative in the previous year following that rate hike cycle. So in other words, what I'm trying to point out here is during that cycle and 6 months after, the CPI again stayed strong and growth went lower. And while in that year of 1980, it didn't really change, the following year, we had a lot of negative months in the market. So Ryan is not wrong. He's showing that stocks can do well during a rate hike cycle. But what his work also showed is that stocks don't do well during a rate hike cycle when that rate hike cycle doesn't work to curb inflation and GDP drops. And that's what I think is happening right now. So when you see things like the Empire, you can get rid of this if you want, Mike, or you can send it to everybody. I don't care. So in that rate hike cycle that we're about to go into, when you've got an Empire Manufacturing Index in New York, right, that came in at down 11.8% when the forecast was up 7, right? It's not a percent, it's an index, right? So down 11.8 when the forecast was 7 and the last was 3.1, positive figures, right? They're tightening into a slowing economy. And if they're not successful in reducing inflation, according to Ryan's work and then my augmented work, stocks are likely to not do well. Now, what can we trade off that? Nothing. I got to go, everybody.
So you put all. Well, thanks for
I was
sharing,
just.
Bob. It's like
It's
that.
not something. It's not something I'm going to put out there. I was looking for something deeper in terms of correlations, as opposed to just Fed's hiking rate. How do stocks do? Well, you got 2 periods in there where stocks go significantly lower, and 1 period where stocks do absolutely nothing. And then the year that follows that, stocks are actually pretty poor performers. For the next year and a half, they average down 0.5% per month, right? It's an average. It's not a great statistical measurement, but it was the one I could do quickly.
And
Right.
also, I mean, here's where we're starting off. I mean, we can go roughly. Here's Q1 GDP. This is off the Atlanta Fed GDP Now tool. And, it's going to fluctuate going into when it's finally released, but it's still under 1%. It's roughly at about 0.5% right now. And it was actually negative a couple weeks ago. And even the consensus, the blue chip consensus is under 2%, which I think is a little high. These normally converge. But we're starting a rate hike with, let's even get the benefit of the doubt, a 1% GDP. You know,
It's it's bad even per Ryan's work. So Ryan's work was to show his RIA clients and their clients don't worry so much about the rate hikes. But what he left out, and I don't believe that he did it deliberately. Again, I don't think this was shady. Okay, was he left out all the other nuances, right? All the other nuances that go into whether stocks go up or down. And in most cases, those nuances are positive stocks because we have American exceptionalism and strong technology. And by the way, I could be wrong about what happens. I'm not predicting that. I'm just saying when you see something like this, don't run out and put everything into stocks because you read something like this, right? The thesis that stocks can go up during periods of Fed hiking is correct. As a matter of fact, the thesis that they mostly do is correct. But there's other components that are different now. By the way, there's another component that supports that stocks would go up during this Fed rate hike cycle. The Fed announces that they're not going to do as many as we thought. That could potentially make stocks go up during this rate hike cycle, but it won't curb inflation, right?
and here's what's interesting. See this last one? I'll just point this out. So they started in December of 15, right?
Mm-hmm.
Ended in 18. Because I remember this one really well. So, and by the way, I have a lot more stuff triggered sell signals in the. I forgot to put that out this weekend in the Dow and S&P. The Nasdaq had already triggered their sell signals and everything else, but we have the Dow and the S&P. And I'm just looking in 15. So they started the rate hike cycle. What was that, December
Yeah.
of
Well, you
15?
can look at that. You can look at that picture or something like that.
Yeah.
Here, I'll
But
look at it. You keep
so
talking. I'll look at
there was a sell signal actually, right around at the beginning of December, right before they started the rate hike signal and something long
it.
term
Yeah.
I follow.
December 16th of 2015, Mike.
Okay, the rate hikes, the sell signal was actually triggered right in the middle of December. But here, so you had a pretty decent sell off it starting into
Yeah.
the rate cycle, but then look what we got here. So
Mm-hmm.
can you get a? It's fine. It's back to cash or not being fully in the markets. But then what do we have here?
Double bottom.
Double bottom. So triggers. So all
Yep.
right, that this is why I like to follow technicals instead of trying to predict something because you could have been out. All right, we're going into that rate cycle, avoiding a lot of the big sell off. Back in, they're keep hiking, but you're now back in because you got a longer term buy pattern.
And the funny
So
thing about this is that's the one that everybody calls the taper tantrum, but yet the percentage return during the cycle was 20.9 positive. But they call that the taper tantrum. It's
So,
just
so again,
silly.
do we know exactly what's going to happen? No. But this is where, when I'm getting multiple long term sell signals, does that mean we can't have rallies? I talked about a rally. I got so many questions. Well, why do you think it's going to rally? Why, blah, 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 blah? Because that's what the technicals led to on these short term rallies. Do I think we're
Right.
going to new highs this year? No. I'm cutting it to 4,500, I think. So no, but could we rally, as I talked before? Could we rally back to this longer term trend line, even above the daily rotation zone? Sure. But I'd start watching for the sell signals again because longer term, I have a boat anchor still around my waist that I'm trying to swim with, and I'm swimming against the current, so we can get these aggressive plays. And that's why at this point I trail and then watch for the sell signal again to go with the longer term trend back down. I saw that wavy. Every Fed hiking cycle in the fiat high debt era has led to some kind of financial crisis somewhere across the world. Yeah, I saw that. How would you explain what stagflation is to a fifth grader? So pretend you're explaining it to me, Bob.
Basically, stagflation is when an economy is stagnant and there's inflation. It's really simple. So economic growth is either flat or negative, and inflation is either rising or steady at a high rate. That's called stagflation. So a
So
stagnant economy and rising or flat at a high level inflation. So we
yeah,
call that entrenched inflation when
and
it's
it's
at a
not
very high
good,
level. It's flat.
especially if
It's not
people
good.
start losing jobs and even wage growth that we've seen wage growth pick up, but it hasn't kept up with inflation. So real wage growth is negative. And then if you
Mhm.
have a slowing economy and people start losing their jobs, it makes it even worse.
Yeah.
And it sort of feeds on itself. And so it's just not good. The Wavy says the faster Powell hikes, the faster the economy collapses, the faster the Fed unleashes the biggest liquidity injection ever. Oh, well, I don't know what's going to happen. I just know my technicals. I can't predict anything. I'll let everybody know when I get the next long term buy signal. See you until then.
It's somebody posted something really, oh, it was Hedge Eye posted something really funny today. He said we should install Chamath Palihapitiya as the Fed governor to hurry up and shrink the Fed's balance sheet because the Fed was so pro buying assets. He'd hurry up and sell everything like he did Tesla and everything else that he pumps.
You mean all his SPACs that he sold it?
Yeah, he would literally empty the Fed's balance sheet faster than anyone because that's what he does with all the stocks that he pumps up.
Yeah, Mr. Pump and Dump.
Yeah,
So
exactly.
So that's where we sit again. Tesla said thanks for the image, Bob. Again, so this is where it's a good twice a week where we get Bob on to. It's not just pure technicals. You get information that you can't necessarily trade off of, but it's interesting.
Yep.
No, that's where people put this on financial TV. Stocks do fine during cycles, and then there's no context for it. Okay, well, great.
Yeah, you need the context. Like, why were there those 2 years where we were wildly negative, and then that 1 year where we did absolutely nothing? And it's because inflation continued to rise and GDP was flat to lower. That's stagflation.
All right. Well, let's see. Let's see. A couple other comments from Sterling starting to see banks tightening their lending policies on cars. So you're already getting stuck. Financial conditions getting tighter from a Sterling perspective. Fed is cornered. This doesn't end well for anyone. Yeah, but this is then again. People have been calling for a limit down day for a while, and we got to still trade the
Mhm.
price action. And if we'll see what happens. And that's why at the end of the day, I can have a fundamental outlook like long term bullish on gold, long term bullish on silver, but I still have to trade the day to day price action because anything can
Yep.
happen day to day. I can say and even within the context of what I talked about, long-term sell signal, but you can still have short-term rallies. They don't invalidate each other.
Yep.
So, anything else you want to say? Because I got to wrap this up in about 3 minutes, and
No,
then
I'm good. Go ahead and do what you need to do. I'll just hang up and I'll talk to you guys on Thursday.
all right. Thanks for joining us, Bob.
See you guys.
Bye. Let me get small Mike back on. I'm gonna have to do some more. Oops, Big Mike's still back on too. Hold on. Big Mike, be gone. Hold on. What? All right. 1 second. There we go. Sorry about that. All right, so there we go. By the way, before Sterling, I saw you put in super chat and bound. I thank you. I will look for that notification. Thank you very much. And Bob, have a great day. Thank you. Let me get back in. Let me wrap this up. Yes, I am watching for follow through, especially in tomorrow morning. This was, again, looks like it did close. So this is a very aggressive short term buy signal, even based off the daily basis, if it wasn't an earlier. Why is it aggressive? Because it's against the daily rotation zone and it's against the weekly rotation zone. Does that mean it can't rise? Yeah, I'm expecting some follow through tomorrow. And unless the Fed shocks something, that 25 hike tomorrow is baked in. So then you have what the Fed has in the press conference tomorrow. And that, unless they really shock the markets, we could even see a rally through option expiration. Remember, that's on Friday. And we are still in that negative gamma mode. So rallies tend to be either rallies or sell offs tend to be amplified. They're not dampened. So you could easily see a continued rally. Now, macro still trumps micro. So we will probably be flatter, not as rallying as hard, and we'll probably slow down right after the morning. I want to see what Europe does tonight. And then I will update all our levels in the next little stock section. So if you can't attend that live, just watch it on demand. But then I expect it to go choppy at least through the what the Fed says, and then we will watch for continued follow through. But again, educational purposes only. How I handle these situations is I like to trail a stop and tighten it up, especially if we start getting downside momentum. So that's how, because, or if we get a topping pattern like a 1 hour double top or something that actually triggers, that will cause me to unwind long positions. Until then, I got to go with this short term bounce until we get a longer term sell signal. With that, oh, how do I manage long term positions overnight during these rallies? I have stops. Literally, if I'm in the futures, I have stops. In the stocks, it gets a little more complicated. That's why I would suggest, and if you are in something like the spiders or the Qs, and then I'll wrap this up, that's why you could also have a futures account and trade micros. Why? Because the micros make it real easy to position size also. So let's say in the middle of the night, the market just something happens in Europe and it starts rolling over. You can, and if you're up for it, I tend to set alarms just so at least I can glance at it. And I can have alerts set up that will pop up on my phones. So if it starts hitting key levels, I can always put on short-term hedges in the futures the other way. So if I was long the spies, I could short some S&P micro futures if the market started tanking to offset that spiders. So when it gaps down the next day, yeah, I take the hit on the stock account with that gap down, but I've hedged it with the futures on that retrace. And then I can reestablish a core position again. Get out of the futures, get out of the spies, and hedge them that way. Otherwise, you're at the whims of you have to trade post market, and there's that period where you can't do anything. So that's the way I do it. So I'm literally on call 24 hours a day, except for Saturday nights. Friday after the market closes through Sunday when it reopens, I'm off. Besides doing the streams, yes, but it's not every night. This is, what, in more stable conditions, you don't have to worry about stuff. Why am I watching it now closely? Because I have long term sell positions. So could we roll over at any moment? Yes, and that's where it makes a challenging environment. But you can set alerts. I mean, the really only thing with Europe that will happen unless something else blows up in China with there's some interesting financial conditions over there. You have the macro thing of Ukraine versus Russia. So I just have alerts that I turn off my sleep mode on my phone, and if they'll wake me up. But I generally just set an alarm also when Europe opens and check in there, and then I check in at again 5 a.m. my time, and then we'll generally I'm up then anyways. So, and I have macro alerts to go off. Other than that, yeah, that's where these environments are. That's why these markets are tough to trade. We can follow up on this in the next session again. Hope it might be 5 minutes late starting, but just watch for that countdown timer. Join me then, and we will look overall at any stocks and update some key levels for tomorrow. I will talk to everyone later. Bye for now.